Tesla stock at the time of recording this video is up 3.5% today. Really following a broader market rally, the S&P is up close to 2% right now. And I'm here to break it down, put it into context, give you the facts, and ultimately, is this the start of a larger market rally? It has officially happened. Tesla has discontinued the old Model Y in the US and Canada. The new Model Y launch series is now the only Model Y you can buy on the online configurator. Tesla has secured a new $290 million Megapack contract to build 4 80-megawatt battery energy storage facilities in Utah. Collectively, the Tesla batteries will store up to 1,280 megawatt hours of dispatchable power. The official Tesla X account says shout out to our owners, especially those who've recently bought a Tesla, as well as our supporters and advocates. You rock. Dan Ives says that Tesla will actually start manufacturing vehicles in the Indian market. Now, I've talked about this before here on the channel. The Indian market is very much a developing market. It's a developing country. It's not going to be a huge driver of sales this year, but it's kind of like China in 2019, okay? Give it 4 or 5 years, and India is probably going to be the biggest market for Tesla. Just again, based on how many people are going from essentially poverty to more of a middle class in the country, how much it's going to be developed over the coming years. And well, you've already seen electric vehicles do okay in India, just they're different, right? They're smaller, they're like 3-wheelers, they're motorcycles. Well, Tesla is really going to be the first outsider brand to even be sold in India, and that does give Tesla a competitive and strategic advantage.
To manufacturing, the Indian government had recently brought out a scheme for manufacturing electric cars in India, whereby companies like Tesla could get a concessional import duty of just 15% to get their cars into the country, but they would have to commit to manufacturing with $500 million. In the current context, would Elon Musk want to commit to manufacturing at all in India, or he would first want to just test the market for a few years?
I would say a few years. I think they put a toe in the water in terms of retail shops and dealerships that ultimately they're going to build out, in India, whether it's 2, 3, or 4. But I do believe as that's successful, and we believe it will, then they start to go down a manufacturing path. I think that would make the most sense, and that's similar to what they've done in other countries. Well, it comes down to they're going to look to, whether it's Malaysia, there's a lot of other areas they're going to look to build. I continue to think India is going to be one of those central areas that Musk and Tesla are going to build out over the coming years, forgetting just this near-term tariff issue, which is obviously clouded not just Tesla, but the overall market.
Option activity today from hedge funds and institutions in Tesla stock is actually really just neutral. You have 68 different trades totaling $42.39 million with a positive order value of 54%. Volume on the call side is 52.61% and volume on the put side of 47.39%. So believe it or not, with the 3% up move today for Tesla, it's not a, super bullish day in terms of options. Now, you do have about 18,000 shares today that are being covered by hedge funds and institutions. That is on net. So you have 128,000 shares being covered, and you have 108,000 shares that are being sold short. So the net difference of that is 18,000 shares that are being covered on. Google Trends data is really moving in the right direction now for Tesla. Look at the Cybertruck here, going from 14 to 21. That's great to see. The Model Y going from 14 to 15. The Model 3 going from 11 to 12. The Model S going from 5 to 9. And the Model X going from 4 to 5. So all indications are that Tesla may actually be accelerating right now. And I think we're going to see that reflected in the data in the coming weeks with insurance registration numbers out of China And as we get more data out of Europe, it's going to become clear the new Model Y is going to be a big seller. Okay. It's kind of like picking off or starting off where we left off with the old Model Y, right? Deliveries are going to accelerate. And I think that's really underlooked and underappreciated by Wall Street today. Clearly, right, the stock is down 50% from all-time highs, and people have a lot of concerns about Tesla's brand, Elon not really being at Tesla. None of that matters, okay? None of that is actually important for the stock, right? Because it's not true, a lot of it. But the fact of the matter is, you've priced in all of that. So even if you think those things are a concern, Tesla's fallen 50% from here. You should have thought of these things as a concern in the 400s. Then you had an argument. But not today. You're actually getting priced for a recession. I've talked about this before. That's why I like Tesla right now, because it is being priced for a recession. If we don't have a recession, there's going to be a lot of upside. If we do have a recession, then you could have downside, but it's, again, probably majorly priced in at this point. Now, another reason why Tesla and really the broader markets are just moving higher today, we'll get into some of the headlines in just a moment, but you haven't seen much of a bounce, and you are overdue for a bounce. Unfortunately, I don't think this is the start of a larger rally to new all-time highs, but a bounce? Sure, could continue a little bit higher. Tesla's 200-day moving average is at around 282. If we could get back to that level, that would be a solid round trip move of about 30% from the lows, which is kind of crazy to think about it like that. But so far, you're up about 14% from the lows. So you've already seen a little bit of that bounce. Could it continue? Of course, but don't bet on it. So first and foremost, the big data today was the Michigan Consumer Sentiment Report. And as expected, this thing is terrible. The headline number came in at 57.9. Last month, it was 64.7. The estimate was 63.1. So yeah, you came in well below where Wall Street was expecting. 5-year inflation expectations hit 3.9%. We were expecting 3.6%. Last month, they were 3.5%. Yikes. Longer dated inflation expectations are rising. This is actually the highest level you've seen since 1993. You have 1-year inflation expectations that hit 4.9%. Last month, they were at 4.3%. And the estimate was 4.4%. So 1-year inflation expectations also moving higher. But what stands out to me in this report is consumer expectations. Consumer expectations plummeted. Last month, they were at 64. You fell to 54.2. You were expecting this to actually move up a little bit, for people to actually feel a little bit better about the future. You were expecting this, again, to go from 64.0 to 64.3. Instead, the opposite happened and you fell 10 points. And when you look at this from a recent history perspective, you've fallen off of a cliff. Like every month has been worse than the last. And now you just look awful. You're getting back to the lows of 2022. The only time you were lower than this was June and July of 2022, when inflation was like 9%. Okay, and you know, stocks were down like 25%. This is really not a great sign for the consumer. In the summary of this data, it says the University of Michigan consumer sentiment for the U.S. plunged to 57.9 in March of 2025, the lowest since November of 2022, from 64.7 in February, and well below consensus forecast of 63.1. Preliminary estimates showed sentiment declined for a third straight month, with many consumers citing the high level of uncertainty around policy and other economic factors. While current economic conditions were little changed, 53.5 versus 65.7, expectations for the future deteriorated to 54.2 versus 64 across multiple facets of the economy, including personal finances, labor markets, inflation, business conditions, and stock markets. Meanwhile, inflation expectations surged, with the year-ahead gauge rising to 4.9%, the highest reading since November of 2022, from 4.3%. Also, inflation expectations for the next 5 years surged to 3.9% from 3.5% in February, the largest month-over-month increase seen since 1993. Renaissance Macro Research says the big news in the UMISH data was not inflation expectations. Look at what people are saying about the jobs market. Expected change in unemployment is the worst since the 2008 recession. No one is asking for a raise in this environment. Just look at this. That is absolutely terrible. And what's alarming is these things tend to historically follow each other, right? You tend to see, this goes back to 78, right? 1978. These charts look pretty much identical. One can, come first before the other. And again, if that's true, you're going to be in a recession in the not so distant future. Again, maybe that they don't correlate. Maybe things are just fine, right? Maybe payrolls continue to be okay, and you have the first real separation here, like ever. I mean, who knows? Maybe that's possible. I think it's improbable, very improbable, looking at this chart. And that is why, unfortunately, these rips will be sold. Investors will continue to sell the rips more than they buy the dips. You can even see with today's rally, it is a fraction of the volume we have seen on any given day. It's like volume today just really fell off a cliff, okay? Not exactly a great sign if you think this is a durable market bottom. Now, with this market, we're so heavily driven by news headlines and what Trump has to say, he could probably stop a lot of this pain quickly, but the overhanging issue still remains. The economy is weakening. We are heading towards a recession, at least in that direction. And if the economy is weakening, you're heading towards a recession, people don't want to go out and buy the dip on a 10% correction. That's just not, again, that's not a good risk-reward setup. Especially, again, considering we were just at all-time highs and you've rallied 20% in back-to-back years. Our expectations just got flipped on their head, okay? We were all expecting a pretty good economy, a cut or two from the Fed this year, but no big rush. Like Trump's trade war, that's just negotiating, right? That's kind of the consensus why stocks were at all-time highs. Well, now we're realizing, oh crap, Trump means business with the trade war. They're willing to sacrifice the economy to get there. Inflation is still an issue. The Fed looks like they're not going to be saving the markets or the economy anytime soon. And again, it looks like we're heading towards recession. That backdrop is not a great one for stocks. And when you were at all-time highs, it makes sense why you've had one of the fastest 10% declines in market history, because our expectations were wrong. What we were pricing in was proven incorrect in a very short amount of time. Does this mean that you're accurately priced for a slowdown in the economy? No, like we're not. And while you can get bounces, and I expect we will get bounces, they will be sold off. Again, yesterday, the markets were the most oversold they have been at since September of 2022. So you were only down 10%. It just happened quickly. In 2022, you were down like 25% before you were this oversold. And that's just because we had bounces, right? We had bear market rallies. We fell a bit rally, fall a bit, rally, fall a bit, rally, and just repeated that cycle over and over again and slowly made our way lower. This time, you've done it very fast. Also, in the consumer sentiment report, it is interesting because inflation expectations really across all demographics went higher. Okay, you can see this here based on political affiliation. So you have Republicans at 0.1% inflation. They're almost expecting deflation. Independents expect 4.4% inflation. That is up from 3% in the prior reading. And Democrats expect 6.5% inflation. Like, no, this doesn't make a whole lot of sense, right? This is like very idiotic, okay? From an actuality perspective, like oil is falling, economy is weakening. Yeah, sure, tariffs are not exactly great on inflation, but the expectations are high, right? They're kind of misaligned with the current situation that we're set with. There was also a big rumor today, really started by Charles Gasparino. This guy has the most outrageous rumors that are never true. He says, quote, "Lots of talk in Trump circles about the need for some grand plan to resolve the tariff disputes with Mexico, Canada, and Europe. That is, cut a deal via one universal settlement. This started bubbling after today's market losses and the growing sentiment that the market upheaval isn't over until this stuff is settled. I have no clue whether this is something the White House is working on, but the chatter among the outside advisors in and around Wall Street and DC is real. The idea is that a compromise. Trump saves face with the base, the trading partners who are now hurting economically because of the uncertainty all get relief. The administration then can move on and focus on broader parts of its econ plan, like DOGE, budget reductions, tax cuts, and deregulation." Donald Trump on Truth Social said, quote, "Our economy will boom like never before." U.S. Secretary of State Rubio says tariffs are not meant as hostile moves. He goes on to say that once trade baseline is reset, then the U.S. can engage in bilateral negotiations for fair long-term trade arrangements. Rubio also says that there is reason to be cautiously optimistic on Ukraine-Russia situation. And Zelensky says that we now have a good chance to end this war quickly. Also, probably helping markets to bounce today, Chuck Schumer announces that he will be voting for the federal funding bill as we get to the midnight deadline, which raises the odds that, or lowers the odds, I should say, of a government shutdown, right? It raises the odds the government will get funded. And again, normally government shutdowns are not huge negative catalysts for markets. Usually it doesn't do anything to markets. Historically, markets actually go up during government shutdowns. But with fears of the economy already weakening, fears of a recession already materializing, to not pay people for a period of time doesn't exactly help things, right? And that's why this could have been a negative catalyst. I don't know how much of a positive catalyst it is either. Again, historically, it's not really a catalyst at all for markets. But it looks like it's going to pass, and that could be fueling some of this market bounce because you were so oversold. You can also see that Putin says that talks with the U.S. are starting to move, and let's see what comes out of it. So people are, getting excited that the end to the war in Ukraine could be coming. And I'll tell you one big thing that will do right off the start. It would lower oil prices, right? To allow some Russian oil to hit the global market. That should lower oil prices even more. And that is a positive for the economy. So structurally, the war in Ukraine ending It's not really a huge catalyst, but when you think about the second derivative moves of that, like lower energy prices, Ukraine is considered the breadbasket of the world in terms of wheat and the food that they produce. Two big areas of inflation, right? Energy prices and food prices could come down as a consequence to that war ending, and that is a positive for markets. And one of Bank of America's strategists, Hartnett, says Trump will flip on trade policy before this turns into a bear market. Which, if that's really your investment thesis at this point, you must have not been paying attention to everything the Trump team has been saying. Detox period, transition period. They don't care about short-term market losses. I don't think a bear market's gonna stop Trump. In fact, I think Trump wants a recession. I think Trump wants a shallow recession to kill inflation, to get treasury yields lower, and this is working by design. But again, this is a healthy bounce in markets. It's pretty abnormal and unhealthy to see markets fall 10% with only really getting intraday bounces, right? You've basically went straight down, and you're finally getting what looks to be a little bit of a base being formed. Now, from the low of the day yesterday, you're already up about 2.2%. So you've already seen a little bit over a 2% bounce. I think we could bounce probably to this 200-day moving average to about 570 on the SPY. Getting above that, I think, is going to be difficult given the data that we're getting. It's just not good, right? Like today, did we really have a justifiable reason to rally 2% on the SPY? No. Okay. Nothing changed. Things got worse as far as recession concerns, labor market concerns, inflation issues. Nothing got better from that perspective. And there's no real reason you can justify this. Yeah, sure, the war in Ukraine ending, there can be positives to that. Does it justify hundreds of billions of dollars of market cap being, gained again today? Probably not. Okay. But it makes sense because you were so oversold. The question is, are the lows in, or are we going to fall to new lower lows? And I'm not convinced this is a bottom yet, that we're at a bottom yet. I think if we get to this 500-day moving average, then you're looking much better for a potential bottom. And that's as the market is down almost 19%. So I think you get another 9% sell-off or so from the low. So you're about halfway done with this. And then if we go into recession or whatnot, then you could fall further, right? But I think just falling to the 500 level is a balanced risk reward in markets. Because the fact of the matter is, I think people are still downplaying the risk of a recession. When you talk to everyone, see what Wall Street is saying, they're really not talking about a recession yet. That's really not in most people's baseline forecast, is even remotely high odds of a recession. People still have it at 10, 15, 20%. What about 50%? I think it's more of a coin toss whether or not we go into recession, and that is not priced into equities at current levels. And I think the best way to really play this right now is to have your long-term portfolio. Don't go out and sell everything. So you can be positioned for the upside, but I'm personally not putting that much money to work right now. And when I do, it's in very specific names, like Tesla down 50% from all-time highs. I think that is better priced for a recession. If there's other stocks that are down a lot that are priced for recession, those look like much better opportunities. But I do think cash is king in this environment when I believe the economy is going to get worse before it gets better. Now, the VIX today is down to 22.41, still overall elevated. You fell 9%. I don't think the selling is over with though. So I don't really care about what the VIX is doing. We have not seen that capitulation event yet. You have not seen that moment that normally marks a bottom, right? This is kind of like 2022, where markets continue to fall, right, throughout pretty much all of the year. But you did have these bear market rallies where the VIX would go down, sometimes to like 19, 20, and then it would go back up into the 30s, and then it would go down again, it would go up again, go down, right? It kept doing this, and I think that could be the new environment that we're going to be in as well, with, the VIX and overall fear that goes up and it goes down. Now, specifically for Tesla, again, same is true. The stock was so oversold, you're bouncing here, even though yesterday in after hours, Tesla warned that they could be affected by reciprocal tariffs. Stock's up 3.5% today. I think without that warning, Tesla would be up a lot more. So I do think it is having some kind of negative drag on Tesla. But again, people are out trying to play a bounce. This is a lot of trading, not for any specific reason. Markets are moving higher, right? There's a much better case that markets should be falling today, but you were so oversold that you're rallying, okay? And Tesla has rallied quite a bit from the bottom. It seems like Tesla led the markets during this bounce. Tesla's rallied about 15% from the lows. You're at this support trend line here, well, resistance trend line. It was support for a while, but that's sitting at about 250. We're struggling to get above 250 now for 3 days in a row. If we can get above that, then it looks pretty good to rally to the 270s or even as high as the 280s to get back to that 200-day moving average. That would obviously lead to a larger rally in the markets as well. And that is definitely possible here. And again, I like buying Tesla here. I have been buying Tesla here, but I'm not going all in at a certain price. I'm scaling into this position, and I want to keep some dry powder on the sideline, because if we do go into a recession, the stock's going to fall further, and the last thing you want to do is spend all of your money without having the ability to buy any more at even lower prices. But I'm not a huge fan of selling stocks either, so I haven't sold anything. So you want to be positioned for the upside in case we're wrong and we get surprised, right? Positive surprises. And you want to be positioned to take advantage of the downside if that does happen. So let me know what you guys think about this down below in the comments section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.